Oil prices have spiked once again. Economies are being affected across the globe from the UK through to India, and this could have some major consequences on both your investing portfolio and your everyday money habits. In this video, I'm breaking down the 3 major stories from last week that all investors need to know right now. Hi, I'm Zoe and welcome back to my channel, Words on Wealth. This is where I break down investing, markets and personal finance in simple terms. And as a former wealth manager, I'm breaking down the stories that actually matter for everyday investors today. And today I'll be looking at, first and foremost, why oil prices have jumped and again, what that means. Secondly, I'll be digging into the UK and their economic growth, notably that it has actually not really moved anywhere. And third and finally, I'll be looking at the case of India, who may also be suffering from some of these conflicts and increased pressures on economies and stock markets. So first and foremost, it's still all about oil prices, and notably how they've gone over that $100 per barrel mark. Now, for most of us, we're not buying oil in the barrel and we don't necessarily know what barrels cost. So what does this actually mean? Well, it means 2 things. Firstly, it means that the price of oil has gone up. Sounds obvious, but that is basically where it's at. And secondly, that $100 mark is kind of psychological. For many governments, for many investors, it will really indicate that actually price changes are there and they've tipped over a certain threshold. And this can trigger lots of other fallout impacts, things like stock market sell-offs, things like wariness within the overall economy and stock market, and may therefore have that kind of ripple effect just from that psychological number. Now, the reason why oil prices have gone up is because of the ongoing conflict in the Middle East. Iran, which is of course being attacked by the US and Israel, is a major global exporter of oil. It's not the only exporter of oil. There are others as well, but some of them are also caught up in the blockage of the Hormuz Strait, which is a part of water that Iran controls and is currently stopping or making it very difficult for multiple ships to pass through with oil shipments. To try and ease this, last week there was a big release of oil reserves. This was decided by around 32 major nations who were all part of a big consortium. This release was the biggest that we've ever seen, and it's aimed to try and bring oil prices back down and soften the blow of the supply being restricted by this ongoing conflict. But this kind of release can't be done all that often. It's not something that can be done multiple times because they're holding back reserves and they've now released those reserves. Not all of them, but what that means is that they have to be built back up again before it can just be done. It's not like turning on a tap and turning the tap back off again. And also, it seems to be that ongoing fears of this conflict dragging on aren't really taking away what a release of these reserves could actually do. But there's 2 main reasons why an increase in oil prices and this ongoing conflict in the Middle East really impacts you, your investments and your finances. First, let's tackle those finances, because really what we're going to feel is the impact in our pockets. If oil prices go up, what is likely to happen is that we see inflation go up as well. Ultimately, oil pins so much of what goes on in the global economy, from shipping prices to the petrol that we put in our cars, to the manufacturing of products that requires oil. You name it, at some point oil will have been involved. And if the price of oil goes up, you've kind of guessed it, the price of the product goes up. Now, most governments and central banks are desperately trying to avoid inflation going up again. In the vast majority of Western economies, we saw inflation go up 2 or 3 years ago, and in some places it hit the 10% mark. Most governments aim for it to be around 2%. Now, if it's exceeding that 2% mark, there are many consequences on the economy, and rarely are they superbly positive. As a result, in the vast majority of cases, central banks seek to raise interest rates to be able to control inflation. The reason why they do that is because firstly, it makes borrowing more expensive, so people have less money in their pockets. And secondly, there's a greater incentive to save in cash because you get a higher rate of interest for money in savings. Both of these consequences mean that people spend less and hopefully inflation comes down. But interest rates being higher is also relatively unappealing for many, particularly those looking to get a mortgage or those on variable rate mortgages who may well see the pain of a higher interest rate. It's also commonly correlated that higher interest rate means lower economic growth. I'll come to talk about economics in the next two stories. The other main consequence of increased oil prices is on the stock markets. As mentioned, oil prices pretty much underpin everything that goes on, and therefore the stock markets also see a similar consequence. Now, what we've seen over the last few weeks is that particularly the US stock market is not looking superbly happy. In fact, most major sectors, apart from tech, are down since the invasion started to take place. That's because people are fearing that the likes of consumer goods, luxury goods, materials, healthcare even, are all going to potentially cost more. There's more uncertainty in the system, and this means that there is an investor fear, and that brings values down ever so slightly. So the key takeaway off the back of that is that when we're looking at our investing portfolios, they're probably looking a little bit uncertain, just like all of us feel about this conflict, about the potential for future inflation, interest rates, and whatever else is going on. But what is likely to happen into the future is that it is all tied to this conflict. The longer that the conflict goes on, the longer that the uncertainty drags on. Equally, the longer that the conflict goes on, the more it becomes the norm. And it's awful to say because that is still taking place, of course, in the Middle East. But the markets gradually adjust to the realities of what it could look like and what that means for pricing in. So this is likely to be short-lived on portfolios, even if some sectors do feel longer-term pain from the likes of increased prices. So for you and your investments, hold tight, because there is some of that short-term worry, but hopefully it gets ridden out into that long-term view. So on to then the second story, which is all about the UK economy. It was announced last week that the UK economy did not grow in the month of January. It remained entirely flat at 0%. Now, normally economic growth is measured by GDP, standing for gross domestic product. And this is basically a total of all the output that an economy produces. Usually, when we're looking at this month-on-month reading, it quite literally is how much more it's grown since the month before. There's also normally forecasts in there and expectations based on all sorts of predictions that economists are running. And most had predicted that it was going to be slightly higher than what it came in as. The GDP measurement is taken by covering lots of different areas and aspects of the economy. Of course, it's the total output. And normally, therefore, we can see from the breakdown what has done well and what hasn't done so well. When we looked at January for the economic reading in the UK, it was actually spending on food and drink services that had dropped unexpectedly, more or less resulting in this 0% growth. Now, January often is a tough time for eating out. People are normally on a bit of a crunch in the UK, particularly after the likes of the festive season, January being generally a bit duller and wetter, and therefore people spend less. So this isn't particularly unusual. It's just not quite what the government or the central banks, or indeed the rest of us sat in the UK, want in terms of having no growth whatsoever. It was described as relatively subdued, with further warnings thrown in as well that the longer that the conflict in the Middle East lasts, the likelier it is that economic growth remains relatively stagnant, subdued, whatever other word that you want to throw in there is. So what does this mean then for you and your investments? Well, first and foremost, if you're sat in the UK and you're looking at these economic growth results, it's not all doom and gloom. It's not negative growth, it's just not any growth right now in January. This doesn't mean it won't change in February as the weather did get slightly better and people generally pick up a bit more with their spending, but it's certainly one to watch as this conflict does continue. In terms of investments, it is important to separate economic growth and stock market growth. In fact, the UK stock market, the FTSE 100, finished last week moderately in the green. Not loads, but a little bit. And this is counter to that economic growth figure. The UK had also had a relatively strong start to the year on the stock market. In fact, it was outperforming the US for much of 2026. What this means is that actually the stock market is looking pretty buoyant for the moment. So from an investing perspective, don't let it deter you and make sure you keep the two separate in your mind. And last but not least, on to India, which has been for the last few years one of the quickest growing major economies on the globe. They have been absolutely booming. For a period, both India and China were kind of neck and neck. With a property crisis in China and then COVID-19 hitting pretty hard, they have struggled to keep up with the growth that India has seen. India has also enjoyed a relatively long period of booming growth and quite low inflation. This has meant that both domestic demand and the likes of the cost of living in India have kept up, and so spending has maintained both in the country and outside of the country. Now, India was hard hit with US tariffs earlier in the year, but it's now been hit again as an economy by what is going on in the Middle East. There's a few reasons for this. Firstly, there are many Indians, over 10 million it's estimated, that live in the Middle East and send remittances back to India. This means that they're basically just sending money back to India and pumping it back into the domestic economy. This is great news from an Indian economy perspective, but if that starts to slow with what is going on, that could present some slowing as well. India is also, of course, heavily reliant on trade from the Middle East, both when it comes to oil as well as other raw materials. The conflict and the slowing in shipping due to the Hormuz Strait being somewhat blocked has a real potential to cause some hefty issues for inflation in India if it pushes the prices up because supply's down, but also to their overall economic growth as well. So what does this mean then for you and your investments? Well, it's not unusual for India to feature in people's portfolios, because usually it's deemed to be an emerging market, and given that it has been booming so much in the last few years, it normally plays a relatively prominent part if you've got the likes of emerging market funds. If this starts to slow, we might see an overall slowing in some other emerging market nations as well, and this could well have an impact on certain portfolios. With any luck, they'll be able to ride out these bumps and we'll continue to see the relatively hefty growth. In fact, they're still predicted to be at around 6% economic growth, not stock market, because keep them separate, just this year. But it is worth remembering that those emerging market categories can be slightly higher risk. And it's certainly one to keep an eye on if you're interested in some of those changing levels that can take place within investing and economies as well, and you're seeking some slightly different returns to what you might see in more developed markets, for example. So there you have it, the 3 key takeaways from this week's markets that you need to know for your investments and your finances as well. Do make sure that you like and subscribe if you're enjoying these updates. I'll be back next Monday for same again.